Hi, this is Sirisha from Master of Business Administration from Institute of Aeronautical Engineering. So today's topic is ledger accounts. So coming to ledger accounts, ledger account is a book where it contains all the accounts, and we are going to classify all the accounts from the journal entries. So coming to ledger accounts, we can prepare different types of ledger accounts like asset ledgers, uh, liabilities ledgers, and revenue type of ledgers, expenses ledgers, as well as general ledger. So coming to asset ledger, so what are the asset ledgers? So first we must understand what are the different types of assets we get in the organization. So coming to land, building, like machinery, furniture, all these are assets. So these assets are like which we are going to invest on the assets. We invest on the assets not very frequently. So whatever the capital type of expenditure we spend, that we call it as a assets like machinery, building, furniture, land. All these we invest only once or twice, or which is not happening regularly. So all the capital type of expenditure we are calling them as assets. And we are going to prepare how much machinery is there. Like when we set up an organization, we may purchase 100 machineries. So that may cost around 1 lakh or 1 lakh rupees. So this 1 lakh rupees we have spent. So every year we are using that machinery, so it becomes older. So for that we charge depreciation. We charge depreciation on that. So that 1 lakh becomes lesser amount. Let us say if the depreciation is 10%, so 1,000 we are going to reduce. So 99,000 will be the balance of or worth of machinery which we are going to have in the organization. Likewise, furniture or building, all these are become older. When they become older, they are going to have have the depreciation, and the amount of the value of the asset will be getting reduced. So once it is reduced, as well as to run the organization in a proper manner, we have to buy few more machinery for expansion of the business, or we may buy buildings, we may buy furniture. So for the expansion purpose, we may buy all these things. So that machinery, excess machinery, if we have purchased for the worth of 10,000, so this will be added for this 99,000, and it becomes 1,09,000 now. And on this, again, after 1 year, we charge depreciation. So like that, the value of asset can be known by doing a ledger account, which is like asset ledger accounts, where machinery, land, building, furniture, all these type of ledger accounts. Now coming to liabilities ledger. So liabilities ledger, when we talk about liability, the first liability we see is the capital. So capital is the investment made by owner or a partner. If it is a partnership firm, it is a or the partner is going to partners are going to invest some amount of capital. So this capital is the major liability for the organization, because organization as always feels that this capital has to be returned back to the owner all the time. So that is the biggest liability for the organization. So here, loan account, bank overdraft account, all these are liabilities where the organization has to pay back to the loan, has to repay the loan, or has to pay the bank overdraft, all these things. So it is supposed to, if any amount which has to be supposed to be paid in a long term basis, well, like debenture is a debenture Debenture is also a long-term liability or a long-term loan which the organization has taken. So debenture, capital, loan account, all these are liabilities. So we are going to classify all these liabilities accounts and try to understand what is the amount of capital has to be paid back to the owner, or what is the loan amount which has to be paid back to the bank, or what is the bank overdraft, or all these things can be understood by doing this liabilities ledger account. And coming to revenue ledger and the expenses ledger. So here in the first two, assets ledger and the liabilities ledger, we are going to spend the capital type of expenditure, or we are going to receive capital type of income, which is not happening very frequently. So it occurs once in a year or twice in a year, or not happening very regularly. So we are not going to take loan every month, or we are not going to invest, or we are not going to invest capital very frequently, right? Once when we set up the business, we require capital. So we are not going to take the capital every month from the owners. In organization point of view, I'm talking about. Okay, so now, so asset and liabilities accounts are like which are not very frequently happening, but when you come to revenue ledger and the expenses ledger, these are which are frequently happening. So these we call them as a recurring ledgers. Okay, both of them we can call them as recurring ledgers. So revenue ledger, coming to revenue ledger is which we are going to receive some kind of regular income, like commission earned, rent received. We receive rent regularly, we receive interest regularly for the amount which we have given to somebody else, and on a debt basis. So these are revenue ledgers. And coming to expenses ledger, so here we are going to pay, when we have to run the organization, we have to pay to our employees, and we have to pay wages, we have to pay salaries, we have to pay rent, we have to pay interest, we have to pay commission. So all these are regular expenses. So we have to pay advertisement charges, we have to pay electricity bill, we have to pay telephone bill. So all these are regular expenses which are happening very frequently in the organization. So all these are expenses ledger. So we are going to prepare all these ledgers by classifying, by taking the entries from journal. So now coming to debtors ledger. So debtors ledger. So first of all, we must understand who is debtor. When we are going to sell goods on credit basis, So we are selling goods on credit basis to our customers. Then if the customer is not paying us immediate cash, then we call it as debtor. That customer will become debtor, where he has to give some amount of money to us for the item which we have sold to him. So that person is called as debtor. So when we are selling on credit basis, then it is our customer becomes debtor. Okay, and this trade debtors account we have to prepare, because we may be selling goods on credit basis to different people, so different customers. So we have confidence on that customer that he's going to pay back on some later on date, let us say 1 week or 1 month, something like that. So we have that credibility with that customer. So that customer is, we are agreeing with the customer to pay the amount to us on a later on date. So that customer become debtors. Likewise, here we must know how much amount of debtors, how much amount of money is lying with the debtors. To know that, we have to prepare a trade ledger accounts or debtor ledger account. Likewise, we also have creditors ledger. So coming to creditors ledger, here when we are purchasing goods on credit basis from our supplier, then we call it as creditor. That supplier will become creditor to us. So now coming to creditors ledger. So like as same as the debtors account, the creditors account is when we are buying something. We may buy raw material from our vendor. So when we are buying raw material, so we are just like stating him or informing him that he is going to we are going to pay back the amount of money within 1 month once he received the bills of accounts from the organization. Then he is going to promise that he is going to pay back to his we are going to promise that we are going to pay back the amount of money to the vendor after a month. Then that vendor is going to become creditor. He is a creditor to us. So likewise, to how many creditors we have to pay, to how many vendors we have to pay, what is the total amount of creditors we have. So that amount we must know. To know that, we have to create or we have to make the creditors ledger account. And now coming to general ledger account. So these are like adjustment ledger accounts, like prepaid insurance or outstanding salaries or landlord account. These are which are not covered under debtors account, creditors account, capital account, that is liabilities account, asset account. All this above, whatever accounts we have discussed so far, if they are not covered, then the general items of ledger will be falling under this category. So these are the different types of ledger accounts which we see. And now coming to the pro forma of ledger account. This is the format of ledger account. So basically, this ledger account is of T-shaped account, where the left hand side we call it as debit side and right hand side we call it as credit side. So this is a T-shaped account. So this entire part is called as debit side, and this part we call it as credit side. So now coming to this format of this ledger account. So on the debit side we have date, particulars, JF, that is journal folio, and the amount, debit amount. Now coming to credit side, so date, particulars, JF, journal folio, and the amount of credit. So this is the format. So this is a T-shaped. So left hand side we represent with the DR, as it is this DR is representing debit side and the CR is representing credit side. Now going on with a small problem of ledger account, let us understand in a better way. So now coming to ledger account problem. So we have a few transactions which are given to us. So these transactions we have to put it in a ledger account. So for doing a ledger account, first if we are thorough with the journal entries, it is going to be very easy to do the ledger accounts. So first January 5th, first transaction is January 5th, purchased furniture for cash 5,000. So here we must try to do the journal here itself so that it will be easy for us to post in the ledger accounts. So furniture, cash. So purchased furniture means furniture account debtor to cash account is the journal entry, right? So this is the journal entry. Now purchased goods and paid by cash. So the journal entry will be, so purchases account debtor to bank account. So this is the journal entry. Paid for carriage expenses. So carriage expenses, carriage account debtor to cash account is the entry, journal entry. Now purchased goods from Murthy. So purchases account debtor to Murthy account. Now cash sales, that is cash account debtor to sales account is the entry. And now sold goods to Ashok on credit basis. That means Ashok account debtor to sales account is the entry. Now paid cash to Murthy in full settlement. Paid cash to Murthy in full settlement. That is I'm just writing as M account debtor to cash account. And now cash received from Ashok. That means we are receiving cash. So cash account debtor to Ashok. Next, paid rent for the month. So rent account debtor to cash. And the last one, withdrew from bank for private use. So private use means it is a drawings account. Drawings account debtor to bank account. So these are the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These are the 10 ledger accounts, 10 journal entries which we have. So by looking at these journal entries, we must prepare ledger accounts. So here, by seeing all these entries, can we find out how much cash is left over in the organization by January 31st? So that we can able to do by doing the ledger account of cash. So here January 5th we have started the transaction and we have ended the transactions on January 31st. So by looking at these particular journal entries, we can't able to tell what is the cash balance by end of January 31st. Likewise, what is the worth of furniture by end of January 31st, we can able to do by doing the furniture account. By doing purchases account, we can able to understand what are the total purchases we have made. So all these things we can able to do it by classifying these journals by posting into ledger accounts. We can classify the account and understand what is the worth of each category of item we can be able to know. So now going on with the problem, first we shall do the cash account. So the cash account here, how to do the ledger account or how to post the journal entry into ledger account, let us understand now. So now, first here we can see on the top we have to write which ledger account we are going to do. So we are going to do cash account now. Cash account, now as I told, it is a T-shaped format. So this side, this side is debit side and this side is credit side. Now, going on. So here, furniture account data to cash account. Furniture account data to cash account is the first journal entry. Now, furniture account data is the first journal entry. So, here, furniture we have to write on the credit side because cash is on credit side of the journal entry. So, journal entry is furniture account to journal entry is furniture account data to cash account is the journal entry. Now this cash account we are preparing. So this above item of the journal will become credit side of the cash account. Now next one is purchased goods and paid by check, that is purchases account data to bank account. Here there is no cash entry or there is no cash item in this particular transaction, so we have to ignore this. There is no cash in this particular transaction, so we are going to ignore it. And now coming to the third one. So January 8th, paid for carriage 500. Carriage account data to cash account. Again, cash account in the journal book. Here, to cash account indicates it is credit side. Carriage account is on debit side in the journal book. Whatever is there in the debit side in the journal book will come into the credit side in the ledger accounts. So cash account is on credit side, so we have to post this carriage account in the credit side like this. So see, cash account is on credit side, so carriage account data to cash account. So cash account is on credit side in the entry, so carriage also we are going to write it on the credit side. Now going to the next item. Next entry. So purchased goods from Murthy. So here entry is purchases account data to Murthy account. Here there is no cash item in this particular entry, so we are going to ignore this. Now coming to January 18th, cash sales 32,000. That means here the entry is cash account data to sales account. Cash account data to sales account. Now, cash account data to sales account. So, 32,000 we have to write on the debit side. So, cash account is on debit side. So, sales also we are going to write it on debit side to sales account 32,000. And now, going with next transaction. Here, Ashok account data to sales account. There is no cash account in the entry, so we are going to ignore this. And next one is Murthy account data to cash account. So cash account is there here. So cash account is on credit side of journal entry. So Murthy account we are going to write on credit side. So we can see Murthy account on the credit side 34,200. And now going with the next one, January 28th, the cash received from Ashok 20,000. So cash account data to Ashok account. So cash account is on debit side. So to Ashok account, we are going to write it on debit side to cash account 20,000. And now going on with the next one, paid rent for the month 2000. So entry is rent account data to cash account. So rent cash is on credit side of journal entry. So rent we are going to write it on credit side of the journal entry. So credit side journal entry. So next, drawings. Withdraw from bank for private use. So drawings account data to bank account. There is no cash transaction here. So we are not going to write anything here. Now we are left with capital and bank account. If the entry is cash account data to capital account, then cash account data to capital account, we have to write in debit side. Capital, we have to write it in debit side. And January 1st. And next one is January 3rd. So if the entry is bank account data to cash account, then we have to, cash account is on credit side of journal. So we have to write bank account on the credit side. So after writing all these, after posting all the journal entries in the cash ledger account, we have to make a balance account. So that we'll understand what amount of cash is left over by end of January 31st. So the total of this we have to make the credit side and also debit side. So let us see what is the total of debit side. 50,000 plus 52,000, 1,02,000 is the total amount which we have got in the debit side. Now coming to credit side, 25,000 plus 5, 30,000, 30,500, 30 plus 34,000, 64,700, 66,700. So total of credit side is 66,700. Now we have to balance this account at the end of that particular month ending. So now the total of debit side is more than the total of credit side. So we are short with some amount of money or some amount of balance in the credit side. So let us deduct that amount from here and try to understand. So 35,300 is the balance amount, which is 35,300. So this we should not write the totals here. So on Jan 31st, we have to write by balance carried down 35,300, and the total of credit side will become 1,02,000 and debit side also 1,02,000. Now 1st February we have to get down this 35,300 balance to balance brought down 35,300. That means the opening balance of cash on 1st February 2006 is 35,300. So at the end of January, so the balance of amount in the cash box of that organization is 35,300, and that cash balance we are going to call it as opening balance. So opening balance on 1st February, it is 35,300. Like this, we have to create a cash account, furniture account, liabilities account, capital account, and bank account. So like this, we have to create different types of ledger accounts by seeing the journal entries. Now, when we are preparing capital account, so here again format will be same. Debit side we have, credit side we have. So the entry is cash account debtor to capital account. If the entry is cash account debtor to capital account, so capital account is on credit side of journal. So this cash account also we are going to write it on credit side. So January 1st cash account 50,000. So the closing balance, here there is no balance at all. That means here on 31st Jan, we are going to write it as to balance carried down 50,000. And on 1st February, we are going to bring back that balance amount. So by balance brought down 50,000. So the total worth of capital with the organization is 50,000 only at the end of January. That implies the opening balance of capital on 1st February is 50,000. Now coming to bank account. So how many bank related accounts we have to check first. So first entry, bank account debtor to cash account. So bank account is on debit side, so to cash account 25,000. Next one is drawings account debtor to bank account, because drawings account is on debit side, so bank account is on credit side, so drawings account we are going to write on credit side. Now bank account, purchases account debtor to bank account is the journal entry. So bank account is on credit side, so to purchases account, by purchases account on the credit side we have to write. Now after making the entries, posting all the entries of bank related entries in the bank ledger account, we have to balance it. So again, likewise as we did for the cash and capital account, we have to balance for bank account also. The total of debit side of bank account is 25,000, and now coming to credit side, 15,000 plus 2,500, that is 17,500. So the remaining balance, to balance both the sides equally, that is 25,000, both the sides it should be 25,000, means how much we are falling short on the credit side is 7,500. So 7,500 if we add, it becomes 25,000. So this we call it as on January 31st, we have to write it as by balance carried down 7,500. So after balancing both the sides, 25,000 debit side and 25,000 credit side, here the balancing figure is 7,500, which is not there in the credit side. So that 7,500 we have to bring back to the debit side, so that we'll understand what is the total amount of bank balance we have on the debit side. So here on 1st February, we are going to write it as to balance brought down 7,500 here. 7,500. So we have bank balance of 7,500 on 1st February 2006. That is 7,500 bank balance. That is the opening balance on 1st February. So after making certain transactions, like we have paid some amount of salaries to employees, or we have paid some interest or in the month of February, so those will be deducted on the credit side, and finally the amount which is balancing figure will be the opening balance. So we could understand with this ledger accounts, the balance of bank on 1st February is 7,500. And what is the capital amount which is there, which is supposed to pay, is 50,000. This is liability. When we get the balancing figure on the credit side, that is brought down balance, if we get on the credit side, then we will call it as liability. We are supposed to pay this. If we get the balancing figure, brought down balancing figure on the debit side, that is 7,500 for the bank, that is we are having that bank balance of 7,500. Like this, if we look at the cash account, which we did earlier, we can see here the bank balance, the balancing figure is 35,300. This 35,300 we got on the debit side. The balancing figure we got on the debit side. The balance of cash on 1st February is 35,300, which we are having in the hands of the organization on 1st February. So this balancing figure, always we should check the balancing figure, brought down balance, not the carried down balance. Carried down balance has to be bring back to the brought down balance for the as it is the opening balance of a particular month. So likewise, we can make furniture account, carriage account, Murthy account, rent account, sales account, Ashok account. So when we are preparing all these accounts, we have to make the balance. After doing the balance, then we have to understand to whom we have to pay, how much amount of money is having in our balance in our account, or how much we have to pay, how much we have to pay to Murthy, how much we have to receive from Ashok, how much rent we have paid during that particular month, how much expenditure we have made for the furniture, how much furniture we are having in the on the name of furniture. So all these things can be understood by doing all these ledger accounts. So with this, we are going to end up the ledger accounts. So thank you.
Like, share and subscribe. Hit the bell icon for more updates.